Today, the bears have it. Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news. This is just a quick update on the developments in the US markets overnight as the falls continue. In a way, no major surprise, I guess, given the Fed announcement yesterday. Before we look at the numbers, a few quick points to make. The first is that the US Treasury Secretary said that investors had overreacted to the Federal Reserve's interest rate hikes. It was completely overblown, he said. And that was a pretty unusual and very direct comment from the Treasury. In fact, he says we're going to see a rebalancing out of bonds and back into equities at these levels. And some of the other commentators are suggesting that we could see 60 to 70 billion coming out of bonds and into the equities sector. But I'm not so sure. It looks to me as though the market is somewhat spooked. And of course, not only is it to do with what the Fed said yesterday, but also now the question of a government shutdown, because a partial shutdown could indeed be on the cards unless last-minute political negotiations get wrangled. And another piece of news which is quite interesting, and that is that the regulators have signed off in the US the living wills of 4 foreign banks, namely Barclays, Credit Suisse, Deutsche Bank, and UBS. And the living wills basically are detailing how they would be safely dissolved in a crisis. The Federal Reserve and the Federal Deposit Insurance Corporation said the resolution plans submitted by the banks, whilst they had some shortcomings, were not significant enough to demand stricter rules or additional restrictions on banking activity. So this again is a further indication of some degree of regulation of the banks, but I also think that there is still plenty of wriggle room going on. So far as the markets are concerned, the stocks tumbled again on Thursday as the Federal Reserve's plan to continue its balance sheet reduction and the threat of a partial government shutdown fueled investor anxieties. In fact, at its sessions low, the Nasdaq had fallen 2.85%, and that pushed the tech-heavy index more than 20% below its August 29th high. However, the index, along with the Dow and the benchmark S&P 500, did move up slightly towards the end. And I guess the fallout with regard to the Fed announcement yesterday was the sense that this whole rate right move is pretty much on autopilot, and it will continue regardless, despite whatever political pressure is being applied. We also think that there is going to be continued ruptions between the House of Rep and the Senate with regard to the budget in the US over the next few months, and that will tend to put more pressure on the markets as well. So looking across the sectors, technology and consumer discretionary stocks were some of the most significantly hit, but energy stocks also slid as oil prices dropped to their lowest level in a year. And there were also gloomy corporate reports as well. So looking swiftly across the numbers, the Dow Jones Industrial Average ended up down 1.99% to 22,859. The S&P 100 fell 1.54% to 1,096. The S&P 500 fell 1.6% to 2,467. And the S&P 500 Financials Index, that's the banking sector, fell 0.78% to 386.95. And that's way, way down from where they were a few months ago, highlighting the pressure on the financial sector. For example, Goldman Sachs fell 0.44% down to 168.50. And you can see from the chart that that's a long way down. The overall volatility index, the fear index, continued to rise, up 11.25% to 28.38. And if you take a longer term view, this is a view back to 1990, you can see that now we're in territory which is pretty unusual. So there are 3 or 4 times over that period where the volatility index has been higher. And of course, the volatility index was highest ever around the GFC. But we are clearly in highly volatile and uncertain territory. The Nasdaq Composite fell 1.63% to 6,528. And turning to the bonds, the 10-year Treasury bond was up 0.84% to 2.799, up a little bit, but significantly down, of course, from the over 3% that we saw back in October. But the 3-month was a little lower, down 0.31% to 2.387. And so the question of whether the yield curve will truly reverse is still somewhat open. The gold futures went up 0.63% to 1,264. I think this is a sign of looking for security, and I would not be surprised to see the gold price continuing to rise further as the uncertainty in other sectors continues. And interestingly, Bitcoin had a bit of a bounce, up 5.83% to 4,080. But of course, this is a highly speculative sector, and frankly, people, I think, are trading volatility at the moment. There's nothing fundamentally underpinning the latest moves, and we could certainly see Bitcoin continuing to fall. The crude oil futures fell down 4.05% to 46.22, remarkably low numbers there, and this highlights the continued supply, partly from the US, and the fact that OPEC seems unable or unwilling to control the supply of oil into the system. And so finally, to the currencies, the US dollar index fell 0.67% to 96.39. That may give a little respite to some of the cross rates. We'll see how they trade during the course of the day. But standing back, I think we can conclude that, as predicted, the volatility will continue. It's likely that we'll see more downside, but I think also we may see a little bit of a rush up towards the end of the quarter as people try to square their positions. Therefore, expect more volatility. So my expectation is that we'll continue to see high levels of volatility up to the end of the quarter, and it may well be that on some days we will begin to see some short recoveries. However, the long-term trend appears to me to be down. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you next time.